You know, whenever I sit down to talk about trading, I like to start with the plain truth, not the fancy stuff people dress up for effect. And today's truth is simple. A trader survives by obeying rules that don't bend just because we feel like bending them. That's the heart of market survival. And before we get going, I should mention, naturally, what we're tackling today connects right back to the previous video on hidden levels where breakouts always start, because understanding where a move begins is only half the job. Staying alive through the move is the other half. Now, these rules I'm talking about aren't mine in the way a man owns a coat or a car. They're mine because I learned them in the market, the only way anyone really learns. By losing when I broke them and making it through when I honored them. And if you've been in the market long enough, you know exactly what I mean. Ever catch yourself ignoring a clear signal because you hoped the stock would turn? Of course you have. Every trader has. Hope is cheap. Survival is expensive. The first rule is the oldest one in my book. Cut your losses quickly. Don't debate. Don't negotiate. Don't pray. Just cut. A small loss is a scratch. A big loss is a wound that keeps reopening every time you look at your account. I've watched traders hold a loser because they didn't want to admit being wrong. Tell me, what's harder on your pride, taking a 2% loss now or watching it turn into a 20% disaster later? The market doesn't care about your feelings. It cares about numbers, momentum, volume, and liquidity. That's it. And the moment you ignore what the tape is showing you, you've stepped out of the trading business and into the wishing business. Only one of those pays, and it's not the wishing one. And you'd be surprised how often this rule ties back to chart, reading basics. A stock that breaks its key levels, true levels, not the ones we imagine, deserves no loyalty. You remember how, in that previous video, we talked about those hidden breakout zones? Well, the same way price must respect those levels on the way up, you must respect them when they fail. A failed level is information. Survival depends on acting on information, not emotion. Now, the second rule, trade only when the conditions are right. Sounds simple, doesn't it? Yet most traders can't stand the waiting. They want action every day, every hour. But markets don't pay you for business, they pay you for accuracy. I learned long ago that being out of the market is a position too. If the trend is muddy, if the volume is thin, if the stock moves like it's stuck in glue, why gamble? Ask yourself right now, would you rather take a mediocre setup because you're bored, or wait for a high probability one that practically whispers its intention on the tape? I can tell you which one keeps you solvent. Traders who survive understand that opportunity is seasonal. It comes and goes, and its timing isn't yours to command. Your job is to be ready when it appears and patient when it doesn't. The biggest losses I ever saw came from traders who just had to be in something. They couldn't sit still. But a quiet market is like a quiet ocean. Nothing wrong with waiting for the next wave instead of trying to surf on still water. The third rule is a bit more subtle. Ride your winners with discipline. This is where psychology gets tangled up with price action. Most traders don't fail because they can't find winners. They fail because they cut their winners short. A stock moves in their favor, and instead of letting it develop, they snatch at the profit like a man grabbing coins spilled on the floor. Let me ask you, if you've done the work, read the tape, identified the trend, and judged the risk correctly, why rush to exit just when the market is starting to agree with you? When a stock behaves well, you must let it behave. A trend wants to run, and when the tape shows strength, real strength, not the artificial kind, you've got to give it room. That's part of survival too, because your winners should pay for your losses and then some. But they can't do that if you choke them off at the first sign of profit. The big operators, the pools, the insiders, they ride trends because that's where the money is. Not in quick grabs, but in sustained moves. A trader who doesn't understand that will always be working uphill. And somewhere in the middle of all this, you might notice how these principles circle back to those hidden breakout zones we talked about earlier. A stock that blasts through a real level, one backed by volume, not hype, often wants to travel farther than people expect. And if you've positioned correctly, Survival isn't just about not losing. It's about participating in the move with steady nerves and a clear head. Now, the fourth rule: keep your mind clean and your capital cleaner. A trader's mind is his real instrument. Not charts, not quotes, not news. Those are tools. The mind is the machine that interprets it all. If your mind is cluttered with fear, greed, impatience, or the worst of them all, ego, you're trading handicapped. Think about the last time you forced a trade because you wanted to get back what you lost. Did the market care? Did the chart rearrange itself because you felt entitled to a reversal? Of course not. You must approach trading like a surgeon approaches an operation: calm, methodical, detached. A surgeon who panics is dangerous. A trader who panics is broke. And keeping your capital clean means protecting it like a farmer protects his seeds. Without capital, you don't trade. Without trading, you don't survive. Every bad decision, every revenge trade, every oversized position, those are termites chewing through your bankroll. And once enough capital disappears, so does your confidence. A trader without confidence is like a ship without a rudder, adrift and at the mercy of every wave. But the interesting thing is, the more you follow these rules, the more the market starts to make sense. Not as a friend or an enemy, but as a landscape, a place with terrain you can navigate if you respect it. And as you study the exchanges, the patterns, the breakouts, the pullbacks, the rhythm of the tape, you start to see that survival isn't about brilliance. It's about steadiness, consistency, restraint. Doing the thing you know you must do even when a little voice in your head begs you not to. And when you start thinking of trading this way, as a craft, a discipline, a long game, you begin to realize that wealth isn't built by dramatic moves or wild bets. It's built by compounding smart decisions, avoiding the decisions you know are rotten, and letting time work in your favor. The market rewards those who last. It always has. Now, the real test is whether you can remember these rules not when things are going wrong, but when things are going right. Because success makes a trader careless faster than failure ever will. And the moment you begin to believe the rules don't apply to you anymore, the market will be happy to remind you otherwise. It always does, and it always will. When I say, only trade when market conditions clearly favor you, I'm talking about a rule that separates the traders who last from the traders who merely visit. Most people think the market is a place where you can force opportunity to appear just because you're eager to see action. But the truth is, the market doesn't reward eagerness, it rewards patience. It doesn't respond to your wishes, it responds to the forces driving price. And if you try to trade when those forces are weak, confused, or contradictory, you're stepping into a storm with no compass. The market has seasons, phases where it moves cleanly, and phases where it moves like it's trying to trick every impatient soul out of their money. You've seen it yourself: days when the price slices through levels with conviction, and days when it meanders between them like it's procrastinating. If you act during the meandering moments, you're not trading, you're gambling. And if you gamble long enough, the house always takes its due. When conditions favor you, the tape speaks clearly. You don't have to squint at a chart or convince yourself that a shaky pattern, sort of, looks like a setup. The signal jumps out. The price behaves the way it should behave. The volume confirms the intention. The trend lines up with the broader market. There's agreement between the pieces. Trend, momentum, liquidity, structure. That agreement is your edge. Without it, you're stepping onto thin ice and hoping it holds. Ask yourself something: how many of your worst trades happened because you forced a setup that wasn't really there? Trades you talked yourself into because you felt bored, or because you were itching to make back something you lost earlier. Every trader has those stories. They never come from sticking to solid conditions. They come from impatience disguised as opportunity. A favorable market isn't just about direction, it's about clarity. A strong trend is clear. A clean breakout is clear. A well-formed base with rising volume is clear. What's unclear is a chart full of wicks, low volume, overlapping candles, erratic swings, and sudden reversals that seem to have no cause. When the market looks confused, your job is not to solve the confusion. It's to step aside until it settles. And here's something most traders underestimate. Not trading is a position too. Staying in cash during sloppy conditions is one of the smartest decisions a trader can make. Cash has no drawdown, no stress, no uncertainty. Cash gives you flexibility when the next real opportunity appears, and it always appears. The market cycles through chaos and structure, noise and clarity. But if you burn your account during the chaos, you won't have the capital or the mental sharpness to act when the structure returns. Remember something else. A mediocre setup takes the same effort as a high-quality one, but with far less reward and far more risk. It costs you emotional energy, screen time, stress, and capital, all for a trade you weren't confident in from the start. Why do that to yourself? Why trade out of habit instead of intention? Trading is one of the few professions where doing nothing is often the best thing you can do. A fisherman doesn't cast a net into dead water hoping fish will magically appear. A trader shouldn't cast trades into dead charts hoping for movement. When the conditions truly favor you, the market almost invites participation. And when you act in sync with those conditions, you're not forcing anything. You're following the path of least resistance. That's where consistency comes from, not from brilliance or prediction, but from aligning yourself with the side that has the momentum. And here's an important thought. Favorable conditions don't just appear in price, they appear in your own state of mind. If you're tired, frustrated, angry, or desperate to prove something, even a good market can become dangerous. A clear market demands a clear trader. You can't read the tape properly when your head is fogged up. Market conditions aren't only external, they're internal. Both must align. This principle ties into how trends behave around key levels, including those hidden levels where strong breakouts tend to begin. When the market is healthy and conditions truly favor you, price approaches those levels with rhythm and purpose. You see orderly pullbacks, steady accumulation, clean pivots, rising demand. When conditions are poor, those same levels behave like traps, fake-outs, failed pushes, erratic volume. Recognizing the difference is part of understanding when the market is offering a real opportunity versus when it's simply teasing impatient traders. One of the biggest challenges in trading is that favorable periods often feel slow, while unfavorable ones feel exciting. Choppy markets generate more movement, more noise, more temptation. Strong trending markets feel calm, almost boring. Most traders get tricked by this. They crave excitement when they should be craving clarity. But excitement drains accounts, clarity builds them. A disciplined trader learns to wait. Not reluctantly, but deliberately. They know that waiting is part of winning. They know the market doesn't care about their schedule or their goals. They know forcing a trade is like trying to sprint in deep mud. They know the real edge is not in predicting the next move, but in choosing the right moment to participate. When you accept that you don't need to trade every day, you suddenly become dangerous. Not to others, but to the market conditions that prey on impatience. By choosing when to strike, you avoid the traps that catch most traders. You learn to act when the odds tilt in your favor, not when you feel restless. Trading only when the conditions are right is not passive, it's strategic. It's the foundation of longevity. It's what keeps you in the game long enough to catch the moves that matter. When traders hear the phrase, "ride your winners," they think it sounds simple, almost too simple to be worth repeating. But the truth is, it's one of the hardest rules to obey, even though it stands at the center of long-term survival in the markets. Anyone can enter a trade. Anyone can cut a loss. But letting a winner run, that demands a kind of patience and emotional control that most people don't even realize they lack until they're watching a profitable trade tick against them for a moment and their finger suddenly heady on the sell button. A winning trade feels fragile to most traders. The moment they see green in their account, their mind starts racing. What if it reverses? What if I lose what I already gained? Maybe I should just take it now and be safe. It's incredible how quickly a trader's imagination can invent danger where the chart shows no danger at all. But the market doesn't pay you for imagination, it pays you for execution. and execution means trusting a trend long enough for it to prove itself. When a stock moves in your favor with strength and structure, you're seeing the market agree with your thesis. That's rare. That's valuable. Too many traders treat profits like something they have to steal from the market before it notices what's happening. But the real professionals think the opposite. When the market begins to reward you, that's the moment to relax, not panic. The hard part wasn't the profit, it was finding the setup, reading the levels, timing the entry. Once the trade is working, the real skill is staying out of your own way. Let me ask you something. How many times have you sold too early, only to watch the chart keep running in your direction without you? Every trader knows that feeling. That tightness in your chest, that regret, that sudden clarity you gain once the pressure is gone. You tell yourself you'll ride the next one. But the next time comes, and you do the same thing again because the emotional impulse feels urgent and logical in the moment. This is why letting winners run is a discipline, not a reaction. The real trick is understanding that big trends are rare, but they're responsible for the bulk of a trader's profits. A small winner doesn't change your account much, but a properly captured trend can shift your entire year. If you cut every winner at the first sign of movement, your results become a flat line. Lots of tiny gains, lots of normal losses, and no meaningful edge. Riding winners is what creates the imbalance you need, the large gains that outweigh the small scratches and controlled losses. A trend doesn't move in a straight line. It breathes, it swings, it pauses, it dips. A trader who panics at the first dip hasn't understood the nature of price movement. The market tests you. It checks whether you're committed. But pullbacks inside a healthy trend are simply part of its rhythm. If you've placed your stop wisely, below meaningful structure, not below every tiny wiggle, you give the trend room to operate. When you watch large operators move, you see this principle clearly. They don't jump in and out every time the tape twitches. They position themselves and let time work. Their goal isn't to scalp pennies. It's to capture the meat of the move. If the big money rides trends, and the big money is what drives price, why wouldn't you follow the same principle? Fighting against the way the market actually moves is a losing battle. And here's something many people overlook there. Letting winners run is also a mindset about wealth building. You're reinforcing the habit of holding on to something valuable instead of constantly grabbing at quick gains. You're training yourself to think in terms of accumulation, not extraction. Trading becomes less about instant gratification and more about disciplined growth. The money you make from a strong trend doesn't just inflate your account. It sharpens your judgment, strengthens your confidence, and reinforces the idea that patience has financial weight. There's also a chart reading element to all of this. A true winner doesn't hide its intention. When the tape is healthy, the pullbacks are controlled, the volume supports the move, the structure stays intact, and the stock doesn't violate the key levels that matter. It behaves the way a good trade ought to behave. Sometimes you'll see it retest a previous breakout zone, the kind of hidden level where breakouts often originate, and if that zone holds, it gives you a second confirmation that the trend still wants to continue. Recognizing these behaviors makes holding a lot easier because you're not relying on faith. You're relying on evidence. But even with evidence, your emotions will still try to interfere. That's why the real battle isn't on the screen. It's in your head. Riding winners requires the ability to resist the urge to cash out simply because your brain is uncomfortable with open profits. Most people find it easier to hold a losing trade than a winning one because losses feel unreal until they hit the account, while profits feel temporary and at risk of disappearing. To ride a winner, you have to flip that instinct. You have to see the open profit as a sign to stay disciplined, not bail out. And it helps to think of your winners as soldiers on your side. If a trade is fighting for you, why would you pull it off the battlefield early? Let it advance until it's defeated by legitimate price action, not by your nerves. Your goal is not to guess the exact top. Your goal is to capture the significant portion of the move that the structure allows. When you develop this skill, your trading shifts. You stop chasing every little tick. You stop selling just because you're nervous. You start letting the market prove to you when a trend is truly ending instead of assuming it will end the moment you feel tension. Riding winners is not about greed. It's about alignment with the trend that's already unfolding in your favor. When I say, respect failed levels as loud warnings, not suggestions, I'm talking about a rule that every serious trader eventually learns, usually the hard way. Levels in the market aren't just lines on a chart. They're places where money changes its mind. They represent agreements made by thousands of traders all acting at once. When a level breaks and truly fails, it means the crowd that once supported that price no longer stands behind it. And when that kind of shift happens, you don't argue with it. You don't negotiate with it. You don't try to outsmart it. You respect it. Most traders see a failed level as a temporary inconvenience. They say things like, it'll come back, or it's just a shakeout, or it dipped but it's fine. But a failed level isn't small talk. It's the market sending you a message in all caps. If you ignore that message, the market has a habit of teaching you why you shouldn't have. Think back to a time when you watched price break below a support level you assumed would hold. You told yourself it was noise, that it would bounce. But instead, it kept dropping, and with every tick you felt a little flicker of hope that maybe it would turn around. That hope is how accounts get drained. A level that breaks without strength is one thing. A level that breaks with real conviction is something else entirely. When the market shows you that kind of energy, you must take it seriously. A failed level means the energy behind the previous trend has shifted. It means the buyers have stepped back or the sellers have stepped forward, and sometimes both. Markets don't turn because of your trade. They turn because the weight of money has changed direction. Respecting failed levels is about respecting that shift. It's accepting that the market knows more than you do in that moment, and that your job isn't to fight it, but to understand what it's telling you. There's also a psychological side to this. Traders don't like admitting when they're wrong. A failed level forces that admission. It challenges you to accept reality instead of waiting for a fantasy reversal. Every moment you hesitate after a level fails, your mind starts inventing reasons to stay in. It might bounce. The RSI is oversold. Volume might fade. All those reasons are just ways of avoiding discomfort. But the market doesn't care about your discomfort. It responds to action, not excuses. I'll ask you a simple question. Would you hold onto a sinking boat because you really liked the paint color? Of course not. Yet traders do it every day with failing trades simply because they liked the chart earlier. A chart stops being valid the moment the level it depends on breaks. Sticking with it after that is like trusting a bridge after hearing the cables snap. A failed level gives you information. It tells you where the strength isn't. And when you know where the strength isn't, you can start to understand where the opportunity no longer exists. That's crucial because trading isn't about being right. It's about being safe long enough to be profitable. If you can survive the failed levels, the market will give you plenty of chances to catch the right ones. This ties back to the rhythm of breakouts too. In that previous discussion about hidden levels, where strong moves tend to begin, the importance of respecting levels becomes even clearer. A level that was supposed to launch a breakout, but instead collapses, is giving you one of the clearest warnings you'll ever see. If the side that should have defended the level doesn't show up, that tells you they're either exhausted or gone. And when the supporters disappear, the price doesn't drift, it falls. A failed level can also expose the quality of the trend you're trading. Strong trends respect structure. They test levels, maybe shake them a bit, but they don't break important ones without a reason. Weak trends stumble through their own levels like someone tripping over furniture in the dark. If you're in a trade and the price keeps violating levels that normally matter, that's your sign that the structure isn't solid. A trend without structure is a trend you shouldn't trust. Respecting failed levels is also about protecting your capital. You can't control the market, but you can control your reaction to its signals. If you treat every failed level as a serious sign, you avoid the kind of spiraling losses that come from stubbornness. You stay nimble, you stay ready. You stay aligned with the side that's actually in control. That alone puts you ahead of most traders, because most people cling to losing positions long after the chart has clearly said, "Get out." It's important to understand that not all level breaks are equal. Some levels will break and reclaim quickly. That's normal. Markets breathe. They wobble. But the difference between a harmless dip and a true failure is in the details. Look at volume. Look at momentum. Look at the violence of the break. Look at how fast the price moves away from the level. A real failure is often sharp, decisive, and emotional. The tape speeds up. The buyers scatter. The sellers push hard. When you see that, you're not watching indecision. You're watching a change of control. And once control shifts, your job is to adapt, not resist. The best traders aren't the ones who hold the longest. They're the ones who adjust the quickest. Respecting failed levels is part of that adaptability. It's the acknowledgement that the story you were following in the chart has changed. And when the story changes, you don't cling to the old chapter. You turn the page. If you truly begin to respect failed levels, your trading becomes cleaner, safer, and more structured. You stop giving back profits unnecessarily. You stop letting small losses turn into large ones. You start treating the market's warnings as instructions instead of inconveniences. And in a business where survival is everything, following the market's instructions is often the difference between staying in the game and getting pushed out of it. When I say survival depends more on discipline than prediction, I'm pointing at one of the most misunderstood truths in all of trading. People think trading is about forecasting, calling tops and bottoms, guessing where a stock will go next, trying to outsmart the market with clever analysis or fancy indicators. But prediction has never been the foundation of real trading. Discipline is. Prediction might get you into a trade, but only discipline determines whether you stay long enough to profit or exit fast enough to survive. Most traders spend far too much time trying to be right and far too little time trying to stay alive. They chase signals, they gamble on hunches, they fight trends because they believe they can see something the market can't. But the market sees everything. It aggregates every order, every hesitation, every surge of momentum, every withdrawal of liquidity. It's a machine built on collective intelligence. And no single trader, no matter how skilled, can consistently predict its next move with accuracy. What a trader can do is respond correctly to the information the market is giving in the moment. That's discipline. Think about the last time you tried to predict the market. Maybe you felt confident. Maybe you saw a pattern you recognized or a signal you thought was reliable. But the second the price went against you, your prediction didn't matter anymore. The only thing that mattered was your response. Did you cut the trade? Did you hold on and hope? Did you add to a losing position because you thought you were early rather than wrong? That's where discipline reveals itself. A prediction lasts a moment. A decision lasts a lifetime in your account. Discipline is about consistency. It's about doing the right thing, even when your emotions beg you to do the opposite. The market is designed to test your emotional thresholds. It will lure you into trades that feel perfect and shake you out of trades that are actually working. Without discipline, you'll fall for every trick. With discipline, you start to see those tricks for what they are: noise meant to punish the impatient. Ask yourself something. How many times has the lack of discipline hurt you more than the lack of prediction accuracy? You've probably had plenty of trades where your idea was sound, but your execution sabotaged you. Maybe you entered too early, exited too quickly, or held too long. Maybe you had the right thesis but ignored your own rules because you wanted a bigger gain or feared a small pullback. In each case, the issue wasn't prediction. It was discipline. You didn't need to know the future. You needed to follow your plan. Discipline is what keeps your risk controlled. It's what stops you from taking trades that don't fit your criteria. It's what reminds you to cut your losses before they spread like fire through your account. It's what tells you to stay patient when the market is unclear and to act decisively when it finally offers you a clean opportunity. Prediction can't do any of that. Prediction only gives you a guess. Discipline gives you a system. It's easy to get caught up in the idea that great traders are fortune tellers. They aren't. They're observers. They watch the tape. They read the levels. They understand when the price is behaving normally and when it's sending a warning. They don't need to know what will happen tomorrow because they're prepared for what could happen today. Preparation beats prediction every time. A trader who relies on prediction is often stressed, constantly adjusting their ideas to match their emotions, always searching for reassurance in charts or news. A trader who relies on discipline feels calmer because they operate within boundaries. They don't need to know what will happen next. They only need to know how they'll react. That clarity reduces noise, reduces fear, and reduces the impulsive decisions that destroy accounts. And here's something many traders never understand: prediction is ego, discipline is humility. Predicting the market is a way of saying, I know better than the crowd. Respecting the market is a way of saying, I'll follow the evidence, not my pride.